to do another economic update. You all hear from me every week in my charts of the week, and every once in a while with my little market minutes segment. But every once in a while, I think it's really good to hear from somebody on the outside, and somebody I have a lot of respect for, and you've heard from him in the past, is Bryce Gill, First Trust. As you all know, First Trust is a very strategic partner to our firm. We do a lot of work with First Trust and integrate with them in a lot of different areas, from structured notes to exchange traded funds to now some private equity and private credit work, and we're getting ready to do some work with them also on the working with concentrated positions and things like that. So First Trust is a very strategic partner for us, and so it's a real pleasure to welcome back Bryce. And just a very brief bit on Bryce's background. He's an Austin resident, which is great. He is a graduate of the Miami University of Ohio with a degree in economics, and has his MBA from UT. He's senior economist with First Trust and works on the team with Brian Westbury, for those who know Brian. And I might offer a plug to an award-winning team for accuracy in economics. I believe, Bryce, that was in 2022, right? That y'all won that, and yep. I think we're pretty close on that this year. I guess they haven't awarded 2023 yet, have they? But,
no, not consensus economics, no.
But in any case, he's part of a great team, and you've heard him before, and so it's just a real joy to welcome Bryce back to kind of give us some idea, some his thoughts on the economic backdrop as we enter the new year. Obviously, there's a lot going on, not only geopolitically, but we have an election. There's all sorts of interesting cross currents, and so Bryce, with kind of like that brief launch pad, I'll let you take it away.
All right. Well, yeah. Thank you so much, Eric. It's great to be with you and your clients. Guys, before I get started off here, bear with me. I'm recovering from a little bit of sickness over the past couple of days. Feels like my voice is back at this point, but who knows what's going to happen as we get going here. It's kind of my first test since feeling better. But regardless, great to be with you. Obviously, not a shortage of things to talk about. Volatility is still sort of the name of the game in markets. And I think we really saw that yesterday as we closed out January. We had a Federal Reserve meeting. The result was a huge movement in interest rates and a big sell-off in stocks. And so this is kind of what we've been dealing with for years at this point. And I think as we progress through 2024, we're probably going to see more of that volatility. And so, hey, there's a lot of good news that's happened recently. And I think we have some challenges ahead. And I'm going to try and cover everything that I can in the time that we have today. And then I believe we'll have time for question and answer at the end, or at least I'm happy to stay around for that. So if there's something that I don't cover that's sort of been top of mind for you guys, because obviously, there's so much going on in the world, I can't cover it all in just prepared comments, please feel free to bring that up. I'd be happy to do my best to give you an answer. But, big picture, guys, hey, closing out 2023, entering into 2024, it's been pretty good news in markets. We've seen a big rally. Essentially what's happened is the Federal Reserve has come out multiple times in different meetings and kind of made the point that, hey, inflation's been doing what we want it to do. It's been trending down. The headline inflation rate has fallen from, around 9% to 3.5%. And in a lot of ways, the tone coming from the Federal Reserve has been almost like a mission accomplished, right? And so when the market hears these statements, what they're essentially hearing is, hey, we're going to have rate cuts coming on the horizon. Okay. So the way that we value financial assets, the way pretty much everybody values them, is through interest rates and profits. And so those are the things that I'm going to try and cover. Big picture of interest rates fall. It's good for the paper value of financial assets. And I think optimism about inflation, Fed rate cuts, that's why we see in the markets rally so significantly here over the past, let's say, 3 months or so. And so, hey, for that to continue, basically we've got all these rate cuts priced in from the Federal Reserve. We need to see rate cuts happen to, in my view, sustain market valuations where they're at. And so that's the big open question is, hey, will the Fed be able to cut as much as they're saying they're going to be able to cut, which I think the market's pricing in, 3 to 5 rate cuts, just depending on where you look. And so for that to happen, those rate cuts to happen from the Fed, one of two things needs to occur. Either inflation continues to trend down and gets below their 2% target. That's what they kind of consider normal from an inflation perspective. Or, hey, if we can't get to 2%, the Federal Reserve, would need to see some kind of weakness in the economy show up that would give them an excuse to cut rates to sort of stave off economic pain from like a recession or something of that nature. And so my opinion is, hey, I think it's going to be tough to get to 2% inflation. I'll make the case to you why. And so I do think we'll get rate cuts from the Federal Reserve, but I think it's ultimately going to be because, hey, we see some economic weakness this year. So with that, guys, let me share some slides and we can get into some of the details, the good and the bad, and kind of what to expect here in 2024. So, and these should be showing up. Eric, can you see these okay?
Yes. Yeah. Yes, we can see it.
Okay, beautiful. So, like I said, guys, the Federal Reserve has seen a lot of progress on inflation. We've trended down from like 9% to 3.5%. And so, yes, they've got to be more optimistic in their outlook, essentially floating out the idea that we might see rate cuts this year. And so I want to talk about why we've seen all that positive progress, in my view. Okay. And inflation, at the end of the day, I think it's been overcomplicated a lot, but really inflation's a pretty simple topic. It's just too much money chasing too few goods. And when you think about what we did during this pandemic, well, hey, we printed a whole lot of money and then we shut down the global production system, right? So, there was more money and there was fewer goods. It's like the textbook example of what would cause an inflationary surge. And so my view is the reason we've seen so much progress in the past year really comes down to the too much money side of the problem. And that's the chart that I have on the screen here. What this is what we call the M2 money supply in economics. And then I've just created a 6% a year growth rate trend line. That's like what normal would be. So, what it would do if no pandemic had happened, no emergency COVID programs were initiated, right? So it gives us a good basis of comparison. And the reason we look at M2, guys, is what we call high-powered money in economics. It's basically dollars in people's hands that they can go out and spend. And so, hey, if the blue line sticks right by the orange line, that's basically normal. If the blue line surges way above the orange line, the gap between the two is essentially like excess money in the economy. And that's exactly what happened during COVID. We printed about $5 trillion and sent checks to pretty much everybody in the country, right? Stimulus checks, boosted unemployment benefits, PPP loans. This caused the M2 money supply to surge well above the trend line. And my view is, I think a big reason why we had the inflation that we had, or at least saw it get as bad as it did, is because we dumped a bunch of fuel on the fire with regards to more dollars in the U.S. economy. Now, the good news about this is, the Federal Reserve only has really control over the money and the interest rate side of the inflation problem. And they've done actually a pretty good job, I think, of dealing with this variable. So, hey, what have they done in the past year? They've raised interest rates. They tightened monetary policy. We stopped sending checks out. I guess it hasn't just been the past year. It's really been like 2 years in happening at this point. And so what you've seen over, let's say the past 12 to 16 months is that the M2 money supply has not only stopped growing, but it's actually been falling, right, from that peak around like 2022. And the gap between the orange line and the blue line has been shrinking. So the Fed has not only like stopped the growth rate of the money supply, they've actually been pulling excess dollars out of the system. And so those two lines have been slowly closing in on each other. The excess money in the system has been drained out. This is why I think we've seen the headline inflation rate slow down so dramatically. Okay, and so this is good news because, hey, the Fed, really all they can control is money and interest rates. There's a lot of things they can't control, and I'll talk about those next. But, hey, they've done a pretty good job controlling what they can control, and this has given them a lot of progress on that headline inflation rate. And so this chart right here is why, we're done with rate hikes at this point. They're just kind of standing pat, seeing what's going to happen, and deciding from there whether or not they can, go forward with rate cuts. And like I said, those are going to depend on either hitting their 2% target, which we're still roughly double that, or some kind of weakness showing up in the economy that gives them an excuse to cut interest rates to stave off unemployment, or help out the general economy with kind of easier interest rates and monetary policy. So, I think one thing that's important to note here, guys, is really for the past, since the 1990s, inflation's been at or below 2%. And so whenever we had weakness in the economy, the Fed really could come to the rescue in a pretty significant way, because, hey, their inflation goal was already, accomplished. And so even though I think we will get rate cuts from the Fed, the 0% interest rate policy of like the past decade and a half after 0809, I think that's going to be, very difficult to return to, because what we call like the Fed put, or the Fed coming to the rescue, it's going to be a lot more awkward because, hey, inflation's probably going to be above their 2% target still. So I think we will get some help from them, and I'll talk about why. Hey, the Fed lowering interest rates down to 0 to kind of bail out the economy and the stock market, that's not so obviously going to happen going forward. And a big reason why we've seen, for example, all this volatility in the stock market and the bond market and interest rates and everything is that the Federal Reserve has basically been, a guaranteed buyer, kind of held down the price of interest rates and really like stabilized markets for a really long time. They were the biggest buyer of treasury bonds. And so they've sort of stepped away from the market, and in fact are like actively selling bonds now. And it's meant that, hey, market-based forces have returned to interest rates. And that's why we're seeing things bounce around like crazy. So I've mentioned the 2% inflation target. I've mentioned I think it's going to be hard to get back to that, even though we've made a ton of progress. I think like the last mile on inflation is going to be the difficult part. And so I mentioned the Federal Reserve. Their last couple of meetings have kind of been like a mission accomplished. And kind of what I think about when I hear mission accomplished is George W. Bush on the aircraft carrier during the Iraq War. And I think that's kind of a good comparison, or a good example here, because, hey, at that point, the most intense part of that conflict was over, right? Like, we had defeated the Iraqi military, we deposed Saddam Hussein. However, going forward, there was like this protracted period of insurgency we had to deal with. And I think that's kind of where we're at with inflation, where like the most intense part of inflation is gone. I don't think we're going back to 9%. However, I think this last mile of inflation, like the last 1 or 2% here, are going to be much more of a challenge. It's going to be kind of this protracted insurgency we deal with. And frankly, it's going to be a challenge for some reasons that kind of benefit America. Okay. So there's a trade-off happening here, and I don't think it's all negative by any means. And a lot of people give credit to Paul Volcker for fixing inflation back in the early 1980s by hiking interest rates to like 20%. Okay. And I don't think that that's what solved our inflation problem in like a semi-permanent way. That's not what got us to 2% inflation for 30 years. Okay. I think what helped us fix inflation and kept it low and stable at 2% for, again, 30 years or so was globalization. Essentially, right after this time period, the Soviet Union collapses, China joins the WTO, America and Western markets, we get access to really cheap labor all over the world. Okay. And as a business, your biggest expense is labor. It's about, 60 to 70% of your expenses. So if you can cut those costs significantly, well, it's going to be great for profits. It's going to be really good for the inflation rate, because you can kind of like pass on those cost savings to consumers. However, the downside is going to be, one, U.S. labor sort of loses out here, right? You're competing with someone in China making like 5% as much an hour. But on top of that, okay, what's going to happen is you're going to deindustrialize as a country. So you're going to start producing a lot of things abroad. And this works out pretty well as long as, hey, like you're the sole superpower and free trade is ascendant and Nobody's blocking goods. And, these long, complex supply chains can develop under this situation. However, if something comes along and disrupts these supply chains in a significant way, all bets are off. And that's basically what COVID did, right? These really complex supply chains were destroyed by a rolling series of public health shutdowns all over the world. And right on the tail of that, hey, we've got geopolitical tension everywhere as well. And so what's happened is basically we've seen a huge reshoring boom in the United States. And what I mean by that is basically we've begun to bring back factories to the country so we can make more things for ourselves and don't have to worry as much about what's going on in other parts of the world from like a geopolitical perspective. We'll still care what happens with like China and Taiwan, but hey, if we aren't going to lose our access to semiconductors because of it, it's obviously gives us a lot more breathing room and like options. And so, a good example of this, guys, would be the United States withdrawing from the Middle East, right? Like we got out of Afghanistan, we got out of Iraq. I've heard that President Biden might green light some kind of like military operations with regards to like Iran and Jordan and Israel and Palestine. But big picture, we've mostly left the Middle East because we don't have to care as much, right? We produce all our own energy now. So we don't care about their oil anymore. Similar thing is now happening with manufactured goods for the United States, okay? And so what I've done here on this chart, guys, is I've just graphed out U.S. spending on manufacturing facility construction. And what you see is, hey, in the past year or so, this has basically doubled in a very short period of time. It's gone absolutely vertical. And so the United States is investing a huge amount of money into rebuilding its industrial capacity so we don't have to be as reliant on other places. So the upside here is we become more self-sufficient as a country. Normal people probably see their pay rise more rapidly. I think U.S. labor has more negotiating power these days. However, okay, if really cheap labor abroad got us to 2% inflation for 30 years, and we're not going to reverse that, we're going to start making more things at home. I think short term that is inflationary, and it makes it difficult to get to that 2% inflation number. So a lot of things are happening with regards to global trade and supply chains and geopolitics that are incentivizing this. And I think big picture, this is inflationary. It makes that 2% inflation target harder to achieve. So, hey, if we don't get to 2% inflation this year, and that would be my argument, right? At least not durably. That means the Fed's going to have to wait for some kind of economic weakness to really be able to justify rate cuts. And like I said, all these rate cuts are already priced into the market. So what has me kind of worried is, unless we actually see them go through with this, we could see the market have some sort of a correction, right? And so I want to talk about why I am worried about an economic slowdown and, why, hey, this is probably not that big of a deal for us as investors. It's actually kind of maybe a good scenario, as weird as that sounds. Okay, and so the biggest single component of GDP is consumer spending. It's about 65% of GDP, okay? And, most people in the economics world were forecasting a recession last year, and it never showed up, all right? And so I want to talk through why we are expecting one this year, okay? And, one of the reasons we didn't have a recession last year is the labor market remained very strong. Now, I think a big reason why that was, hey, we're reshoring production. There's more demand for U.S. labor today. Another reason we saw the economy hold up was consumer spending stayed very strong. And I think a big reason why that was this chart right here. Okay, so what I did on this chart is I've graphed out personal interest payments in the United States. So this is the money that people spend on interest, just individuals, right? So like small businesses, corporations, and their interest payments are not included here, but those probably look pretty similar, okay? And so we care a lot about interest payments because this is basically how monetary policy works. Essentially, like, hey, if you're interest costs go way down, right? All of a sudden you have more money to spend on other things and it helps stimulate the economy. Conversely, if interest rates go up, well, short term, that means you have less money to spend on things. You're spending more on interest instead, and it slows the economy down. Okay. So what I did here, I have personal interest payments in blue, and I created a trend line. So once again, we can see like what normal would be outside the context of the pandemic. Now, during the COVID pandemic, okay, consumer spending has held up much better than expected over the past couple of years. I think a big reason why is this chart right here. Okay, consumers during COVID, 2020, 2021, 2022, basically got a threefold windfall. Okay, one is they got a bunch of stimulus checks. So that's obvious. Everybody gets that. Two is, hey, your consumption decisions are restricted, right? You aren't able to go to a restaurant or a bar or go to a cruise or whatever. And so you end up saving a lot of money that then you have available for later on. So there's been all these like excess savings in the economy as well. The third one, though, is this chart right here, I think. Okay, so what this is it's personal interest payments. They dropped significantly during the pandemic because the Federal Reserve lowered interest rates to zero. So everybody was able to refinance their mortgage lower. Student loans got paused. Your credit card interest rates lower. You know, if you were able to get an auto loan, it was at like 1%, right? So people really got a lot of relief on the interest payment side of things too. And so, you know, again, the intuition here is just if all of a sudden you don't have to pay $500 a month in student loans, that's $500 a month you can spend on going out to dinner with your significant other or going on vacation, right? And so I think all three of those things have helped like keep consumers in a pretty healthy place. However, the picture's changed pretty significantly in the past year. All of a sudden, the Federal Reserve starts hiking rates in response to inflation. Well, all of a sudden, interest on credit cards goes up. Interest on car payments goes up. Student loan payments get reactivated. Essentially, what we've seen in the past year is personal interest payments go from about $200 billion a year to now about $550 billion a year. So they actually more than double, right? And that's like actually like 150% increase. And so, hey, this is a huge headwind. That's now $350 billion that's not available for, you know, other purchases, right? And that comes out to be about 35% of the increase in personal income you'd expect to see in a year, right? So this is a huge headwind to people's ability to keep going out and spending. And like I said, hey, consumer spending is about 65% of GDP. Consumer spending is the biggest driver of economic growth in the United States, at least in the GDP sense. And so this is the area I'm most worried about. It doesn't mean the economy is going to drop off a cliff. I think this ends up being a pretty minor recession. However, people are definitely going to see some headwinds here. Okay. Now, that all being said, there's these certain times where like the economy and the stock market are at loggerheads with each other. So a good example of this is excuse me, guys. Whew. I thought I was going to sneeze there. A good example of this, guys, is early on in COVID. You know, the economy is a disaster. Like 20 million people get laid off, but the stock market's booming because the Fed lowers interest rates to zero. I think basically we're in for a similar but not as significant version of that, where hey, we have like a minor recession, things slow down, we have some negative GDP prints. It gives the Fed basically an excuse to cut interest rates. However, you know, and that's really what sort of supports market valuations, because like I said, the reason we've had this rally over the past 3 or 4 months really comes down to expectations that interest rates are going to fall. And so if we don't actually end up getting those interest rate cuts, you know, that's going to end up being a problem for the market. One last thing I want to show you guys, okay, is the fact, and we're going to get more data on this tomorrow, guys, because we get an employment report. So it'll be interesting to see what happens there. But one thing that we've noticed recently is that, even though we see like these good headline numbers on jobs being added, when you look behind the scenes, basically everything that's driving it is like government or government adjacent. So like something like 60 to 70% of the jobs over the past year in the United States have just been government and healthcare related, right? This is not normal. It's normally about 20%. So government and healthcare playing like a completely outsized role here. And a good way to look at this, okay, is what I've done here is I've just looked at government wages and salaries. And I'm just throwing a year over year change here. And basically what you see is like government salary increases are increasing at the fastest pace in 30 years, right? So this is really what's sort of driving the economy, keeping consumer spending going. So we're seeing like the outsized wage growth happening. And obviously, like this is good for like a short-term situation. It keeps the economy growing, but it's also something you tend to see in the lead up to a recession. And it's also not sustainable for the long term, right? Because every dollar the government has, ultimately they need to tax from you, right? So you'd much rather see like the private sector driving things. And this is another, I guess, what I'd call, essentially like a warning symbol that we're getting, I think, towards the end of this expansion here. So probably going to see a lot of discussion about this over the next year because we are in an election year. Obviously, the incumbent party is going to want to say, hey, we're doing so great. And the opposing party is going to want to say, hey, we're doing like awful, right? So I'm sure a lot of this data is going to become much more, publicly, I guess, disseminated. But yeah, ultimately, guys, I think we are in for some type of a minor economic slowdown, and really that helps us because hey, it justifies the Fed cutting rates because I don't think they're going to be able to get to their 2% inflation target. So ultimately, to me today, as long as we get the rate cuts, the market seems roughly fairly valued to me. I don't think, as long as we get the rate cuts, I don't think we need to see a huge decline in the stock market. The big question is whether or not we get those rate cuts, because without them, I think there is downside risk here. And hey, along the way, we're probably going to continue to see a lot of volatility as interest rates and the market bounce around. So with that, Eric, I'll go ahead and stop sharing there. If we want to do any question and answer, I'll be happy to hang out.
Well, I think there's a few things that we want to touch on. I'll let you get your voice back a little bit. But I know, we sit in kind of an interesting spot right here, right? Because the market sold off yesterday because of thoughts that the Fed said, hey, listen, we're not going to, be likely to reduce rates in March. And, that's been my going assumption all along. And I think, the prevailing wisdom, as you said, coming into the year, which was a big impetus behind the stock market at the end of last year, was that we're going to have all these rate cuts and that we're going to start sooner rather than later. And I think the Fed is just kind of trying to tiptoe, right? Because there's all these different cross currents, as I said before, but they don't want a 1937 event where they start reducing rates and then inflation reemerges. Again,
exactly.
They don't want that. So it's just like, how quickly do they go? And so, and I know the market's going to be in somewhat of upheaval might be too strong a word, but be apt for volatility if, say, it's not 5 to 6, but it's more like 2 to 3, and they're kind of tiptoe into this. But we're in an unusual environment where we have short-term rates that are above the rate of inflation, so that in and of itself is restricted, and so it's just kind of an interesting spot. So I see what you're saying. The other thing too, I'm interested to get your thoughts on, consumer credit quality. We talked about consumer, interest payments. We've seen that tail up, but it's not. If you look at it in a microcosm over the last year, like consumer credit delinquencies, mortgage, credit cards, that it gets your attention. If you look at it over, like many years and like decades, it's not that bad yet. Are you looking at that as kind of an indicator of the consumer wherewithal and where they sit?
Yeah. So, consumer credit, I think the one area that looks like worrisome to me is really credit cards. That's like the only area that I see any kind of like concern with. And yeah, part of it is, hey, it dropped way off during COVID. So then it was accelerating very rapidly again. And basically it's breached, it's above like the pre-COVID trend again. So it does look like it's higher than it would have been, but hey, also inflation's higher, right? All these things are in nominal dollars. So it does look like, hey, delinquency rates are starting to rise on credit cards. They're the highest in like 15 years. So we're seeing some of the stuff with credit cards start to deteriorate. I will say that. Now, it's important to say, though, okay, within consumer credit, credit cards are like the smallest component. Mortgages are the biggest. Then you've got like student loans. I guess those look worse just because people have to make the payments again. And then you've got like auto loans, and then you've got credit cards. So everybody's making their mortgage payment. No one's defaulting on their mortgage. Haven't really seen much bad happen with auto loans yet. Student loans, I guess have sort of tipped into the yellow, but really it's just like credit cards that I see anything that's like late cycle or kind of like recessionary or like a leading indicator with. I think, we've started to see those delinquencies tick up, but generally speaking, consumer credit as a whole looks pretty good.
Yeah, and it looks like we've had real wage growth, over, recent memory, and that's the first time we've seen that in a while. So, so that probably helps not only the sustaining the spending cycle a little bit longer. That is probably a big part of why we didn't have that slowdown last year. But I'm going to pivot. We do have a really more of a comment that I'll turn into a question, but it relates to immigration as it kind of supports the implicit labor shortage we have, maybe here in the U.S. I guess it says the comment is, I believe there's a desperate need for immigration reform to help calm down the labor shortage we have here in the U.S. And just the thought that might create a more competitive labor market and fill the open jobs within the industrial economy. So I don't know if you want to wade into immigration policy and how that supports our labor base with the backdrop of this kind of increasing onshoring and kind of playing defense with our supply chains, that whole thing.
Yeah. So, listen, the immigration thing, the problem here is, okay, yes, do we have a shortage of like people to be working in the factories, the reshoring industries, all this stuff? Absolutely, right? The reality is Americans just don't have as many kids anymore. And so without immigration, the overall level of the population would go into collapse, and basically like every government program, Social Security, Medicare, Medicaid, all this stuff would like be bankrupt very quickly. And so just for the government budget to work, right, like the economy needs to see a rising level of population. Now, the problem here is, okay, and I 100% agree, like we need immigration reform. That's pretty serious. The problem here is, okay, the quality of people is not uniform that are coming in. Okay. So right now we're seeing more border encounters in the United States than live births a month. Okay. So the reality is the vast majority, like 90% of the people that are coming through the southern border have less than a high school education. Like they're not going to go work in a semiconductor fabrication facility. Right. And so what we need is a lot of skilled, educated immigrants. Those are basically like a free lunch for the United States, right? You get skilled labor that you didn't pay to train. That's a great deal for us. It's immediately a positive to the treasury and the economy. I'm trying to remember who did this study. I believe it was the Congressional Budget Office. They essentially looked at like the economic contribution of immigrants by skill level or like education level. That's how they did it. And basically everyone with a high school education or above is immediately a positive economic contribution. We should want them in the country. The problem is most of the people that are coming in illegally do not have a high school education, right? And so that's why we desperately need immigration reform. We need them to figure out the border situation, probably by really cracking down on who comes through, and then radically reforming how easily it is for people to get legal status in the United States. If you have like an advanced degree from a U.S. university, for example, stamp a green card on there automatically, right? This stuff is not that hard. And so the debate, the problem here is people are looking at this as like a uniform set of people, and it's not. The vast majority of people coming through are not going to be economic contributors till probably like 30 years from now, when they have kids and that generation starts paying taxes. So, and in the meantime, right, like public services and everywhere, all these places gets completely overwhelmed. And so, yes, we definitely need immigration reform, and we need it to massively skew towards like skilled people. And everybody else, unfortunately, they're going to have to deal with a lot more, difficult situation to get in. I mean, I think that's basically the way you solve it. And I don't think that's even controversial to pretty much anybody, it's sort of surprising that this is not something that's, a politician can articulate or get done policy wise.
Well, I'm not sure I'd give too many members of Congress credit for, strong financial and economic acumen. But well, the other thing I wanted to, and you touched on it briefly, was government spending overall. In that formula for GDP, which is consumption, investment, government spending, and net trade. I mean, government's been pretty important to that, of course. I mean, with stimulus and whatnot, but and listening to, and this may not be intuitive to some people, but the government says, well, okay, fine. Well, we're running a massive net deficit right now, and hopefully that curves because it's unsustainable. But it's getting harder because we don't have that natural first buyer, being the Fed of Treasury issuance, and some of those auctions have not gone particularly well. So as you kind of like bump up against those limiters, and we know that net interest cost is like going to push $1 trillion on our federal debt. At some point, does that just crowd out government spending and put a lid on it? Maybe crowding out is not the right word, but
no, I think it's absolutely the right word. I mean, guys, basically what I was talking about with consumer spending, right? Like, it's the exact same thing with government spending, and it's the same thing with corporate spending. Like, when you borrow, it boosts consumption in the short term. And ideally what you do is like you take all that money, you invest it into like something productive. And so like down the road, like, yeah, you have more interest payments, but you have more cash flow as well, right? That's kind of like that's productive debt. And so the problem in the United States is like everything we've spent money on for the past 20 years has been unproductive. It's been wars in Iraq and Afghanistan. It's been, Social Security, Medicare, Medicaid, which they're good programs. I'm not saying they're bad or should be eliminated, but they're not productive. They're not boosting productivity in any way, right? People had less kids. And so, hey, you have to borrow money to keep those payments going out, right? And so in the meantime, what's kind of fallen by the wayside is like government investment in like science and like, technology, government investment in infrastructure. And so unfortunately, now we borrowed all this money and we have basically very little to show for it in with regards to like higher productivity and ability to pay it off. And so, yes, essentially we're just spending a huge chunk of the budget now on interest and getting nothing for it. And so this is going to continue to be weighing on economic growth probably for a while. And for them to make the budget work, they either have to cut spending on something that is helpful, right? Like science, technology, infrastructure, whatever, or they have to raise taxes. So people have less money on that side. And so we're in kind of a bad situation here, one that's been warned about endlessly, but nobody cares when interest rates are falling for 30 years. It's kind of there's no incentive to deal with it. I think there is an incentive now. Ultimately, it's another reason why I think, the Federal Reserve is kind of just looking for an excuse to cut rates. I mean, we can't keep interest rates at 5%, or higher for decades. It's not possible, right? So yeah, I mean, we need to figure out the spending side of things. But once again, it's mostly just driven by demographics. People have less kids. There's less people paying into Social Security, Medicare, Medicaid. There's more people taking out. This is just like demographic. It's structural in nature. And this is another reason why they want to let as many people in as possible, right? At least those people are paying sales tax. At least they're paying, like, in a roundabout way, they're paying property tax on whatever apartment they're living in, right? So they view it as like basically a way to raise revenue and keep the checks going out the door.
Yeah, that leads into all sorts of other conversations about social safety nets and things like that, which I know we don't have time, probably nor the scope to get into here. But I guess maybe just kind of broaden things out, right? Because we've been drilling down on some kind of specific things, and I think we're very much in alignment of a slowdown. You guys are actually predicting a mild recession, so what does that translate in terms of like unemployment rate and things like? Because I know you deal in more specifics, and then what does that look like as we transition out of 24 and into 25?
Yeah, so I think basically what we're looking at is about a 0.5 percentage point decline in real GDP in 2024. So that's pretty minor. I mean, it's not a huge decline. I think, about 2-3 percentage point increase in unemployment. Once again, very minor. We're at like a 50-year low right now. So that doesn't seem crazy to me at all. I think this ends up being a lot like the recession that we saw during like the tech bubble, right? Where Main Street's sort of affected, but it ends up being pretty mild and we're done with it in like a year. So I don't see this as like the end of the world at all. Once again, I think it helps justify Fed rate cuts, which is really what current market valuations are basically riding on. So if those don't happen, again, that's sort of the concerning thing to me. Or even like, Jerome Powell comes out and just sounds too hawkish, right? All of a sudden, interest rates are at 5%, right? We're in this crazy time again where everything just is dependent on the Federal Reserve. And that's not how an economy is supposed to work, but it's where we're at.
Yeah, they can't manage fiscal policy for sure.
Right.
Let's see. I don't know if we have any other questions. Maybe some closing comments then, and we can let you go, Bryce. No, I think this is a really good update. I kind of liken this to, as I've used this metaphor in a lot of client meetings. It's like you have this relatively calm pond. You throw a big rock into it, and you create these massive ripple effects. And so, having never been through this, and I know Brian Westbury's talked a lot about this. It's like the stimulus and all of these reactionary things that, in retrospect, didn't have to happen. Based on the statistics, and Jim Bowen is famous for his COVID statistics, but it almost feels like, in an awkward way, we're kind of at the tail end of these ripples, and eventually it gets back to what we would kind of characterize as kind of like a normal economic cycle again, because we've had all of this dislocation, like you said, the money supply growth, and and I talked a lot about how money supply growth has actually been negative, and you mentioned it, but we're still above that line, right? So that trend line. And so, and the other thing too, which I think is important to mention, like you dig down into the lower socioeconomic layers, I mean, these people they're not feeling as good as maybe a lot of other folks. I mean, because we've had this outsized inflation, but we haven't had deflation. So I mean, we've just had they've been paying higher prices, and maybe that rate of inflation has gone down, but they still have experienced that price inflation that for food and other things that they're having to pay for services. So it's and I know that's kind of an election thing too, is how the lower economic layers really feel about how the economy's treating them. Right? Might be a little different than how it's treating the rest of us, maybe. So I don't know. I just thought if you had a few closing comments on that, then we can kind of wrap up, being that there are no additional questions.
Yeah, well, listen, I think one of the most significant things happening is this reshoring effort, this kind of reverse of globalization. The upside here is, once again, like we've seen a huge increase in labor negotiating power in the United States. That's why you're seeing all these strikes happen. Generally speaking, if you look at like the employment data or like the wage data, like the lower down on the economic status, like income wise, the higher your pay increases have been. So those people have actually outpaced inflation pretty handily over the past couple of years. It's been kind of like, middle class, white collar people on fixed salaries that have kind of seen their, I guess, real pay get eroded here. And so we've seen like income inequality decrease actually over the past couple of years. It's been a total reverse of like the decade after 08, 09. So I think there's upsides here. I think the United States becomes more self-sufficient out of all of this, but this is a total reverse of like the status quo on economic policy, monetary policy of the past 30 years. And it's coming off of like this huge rock in the pond, as you mentioned, COVID-19. And so I think we're going to continue to feel ripples going forward. But big picture, guys, I mean, the United States has a lot of things going for it. I think we wind up being fine here. We're just going through this kind of adjustment period that, is causing a lot of volatility in markets.
Very good. Very good. One last check. No additional questions. Really appreciate your time, Bryce, as always. And I think if it were just you and I on the call, I could go on for hours, and you probably would have to kick me off the line. But I know we appreciate the relationship we have with First Trust very much, and appreciate all the time that you spend with us on these periodic calls, and look forward to the next one. And hope the allergies die down a little bit on your end as well as on my end too, feeling a little bit of the cedar. So anyway, listen, we'll let everybody go, but have a great day, and thanks once again, Bryce, for your time.
Yep, absolutely. Thanks, everybody. Have a good one.
Thank you, Bryce.
Take care.
Thank you.
And we recorded that. Yes. I should have given you a thumbs up to start